What's up, everybody? This is Sunko, the Korean Bro. Today is 2024, January 22nd. And let's see what articles we have tonight, okay? Hmm. Will Tesla's profit keep falling in 2024? Tesla profits have started to fall as it cut prices on its vehicles. The company just announced new price cuts in Europe and China. Signs continue to emerge of weakening demand for EVs. The stock soared in 2023, but its bottom line went in the wrong direction. Tesla was a big winner last year as the stock doubled as part of the broader boom in artificial intelligence stocks. So in 2024, however, Tesla stock has gotten off on the wrong foot. The stock is down 15% on various negative news items, hmm, including price cuts in Europe and China, a decision by Hertz to sell 20,000 electric vehicles, primarily Teslas, in a reversal of our earlier strategy to embrace EVs, and recent antiques from a CEO Elon Musk calling for 25% voting power and threatening to build products outside of Tesla. Despite Tesla's surge last year, the company's financial performance didn't warrant much of a gain in the stock. Revenue growth slowed over the course of the year, coming in at 9% in the third quarter or just 5% automotive sales growth. Meanwhile, profits have also taken a dive due to price cuts and increasing competition in the industry. Net income fell nearly 50% from $3.33 billion in the third quarter of 2022 to $1.88 billion the third quarter of 2023. Musk also spent much of the last earnings call bemoaning the impact of higher interest rates and production challenges related to new Cybertruck and a slower ramp in factory production in Mexico as it waits clear signs of an economic rebound. Meanwhile, the company is also losing the benefit of some EV tax credits in the US, with Tesla already slashing prices twice this year and expectations now muted for interest rates to fall soon. The company's return to profit growth seems in doubt. The average Wall Street analyst expects its profit to increase from $3.15, which it has not yet reported, to $3.74, or an increase of 19% that essentially matches revenue growth forecasted at 20%. Can coach cuts keep up with price cuts? According to some Tesla bulls like Art Invest Kathy Wood, the company's price cuts are a sign of strength, as it will help it gain market share and block out rivals that can't compete at lower price points. However, the price cuts in the 10% range have the immediate impact of weighing on Tesla's already narrowing automotive gross margins, which came in at 18.7% in the third quarter. The chart below shows the company's production cost per vehicle over each quarter over the past year. As you can see, Tesla was able to lower its cost of goods sold per vehicle by $2,000 over the last 4 quarters, and the company could do that again, though the introduction of the Cybertruck is likely to push it higher. In addition to the potential savings in production cost, Tesla is expected to ramp up production again next year, as indicated by the 20% revenue growth estimate. Tesla has yet to give a production forecast for 2024, but the price cuts coming on the heels of last year's reductions simply imply that its price per vehicle sold will almost certainly fall again. If it can continue to bring down costs, Tesla may be able to eke out some profit growth this year, especially as its energy and services segments are growing. However, the business looks poised to face another challenging year. International rivals like Hyundai and BYD are becoming more competitive. Interest rates remain elevated, There are broader signs of weakening demand in the electrical vehicle industry. We'll learn more when the company reports fourth quarter earnings next week, but investors should be prepared for its stock to drift lower unless a new growth catalyst like full self-driving emerges. Stock is pricey and its financials alone don't seem to justify its valuation. A once in a generation investment opportunity, one artificial intelligence growth stock to buy in 2024 and hold forever. The once and future king Microsoft. Azure is aiming for a title. Okay. AI could represent the most profound technological shift since the internet. One company is positioned to profit in multiple ways. Artificial intelligence burst into the scene last year, making headlines and sparkling public interest. While the technology hasn't been around in some form, and other since in the 1950s, recent advances have produced models that can create original content and streamline processes, resulting in dramatic productivity gains. This has captured the attention of Main Street and Wall Street alike. Veteran Wedbush tech analyst Dan Nash said generative AI could spark the fourth industrial revolution, adding AI is the most transformation technology we have seen since the internet started to take shape. That's bold view, but one that's spreading true tech like wildfire. Even the most conservative estimates suggest that generative AI could generate more than $1 trillion in incremental spending over the coming decade. Companies positioned to profit from the paradigm shift will capture part of the windfall, enriching shareholders along the way. So, with businesses of both sizes clamoring to benefit from AI, the big three cloud infrastructure providers represent the best avenue to bring this technology to the masses and profit along the way. Amazon Web Services has long been a leader in the industry it pioneered, but Azure is gunning for the title. In Microsoft's fiscal 2024 first quarter, Azure Cloud gained market share at the expense of its rivals. Microsoft Cloud revenue climbed 29% year over year, outpacing both Alphabet's Google Cloud and AWS, which grew 22% and 12% respectively. The reason Microsoft said roughly 3 points of Azure's growth was a result of strong demand for AI. In calendar quarter three, AWS, Azure, and Google Cloud controlled 31, 25, and 10% respectively of worldwide cloud infrastructure spending, according to research firm Canalys. If Microsoft can continue to gain ground into the rivals, it could eventually steal the cloud crown from Amazon. Got Apple here. What else does he recommend? These are the only two current Berkshire holdings that Buffett suggests investors buy. When the page turned to 2024, Berkshire Hathaway had stake in 51 securities. None of the 49 stocks in Berkshire portfolio having suggested its bias from the Oracle of Omaha. However, the two exchange traded funds Berkshire holds stakes in at SPDR or by suggestion made by Warren Buffett for everyday investors. In an interview with CNBC's Becky Quick in 2017, Buffett had this to say when questioned about where investors should put their money to work. I think it's the same thing that made the most sense practically of all of the time, and that is to consistently buy an S&P 500 local index fund. Keep buying it through thick and thin, especially through thick thin. The temptation when you see a bad headlines in newspaper is to say, well, maybe I should keep an ear or something, just keep buying. American business is going to do fine over time. So you know the investment universe is going to do very well. The Oracle of Omaha is well aware the downturn in the U.S. economy and stock market are inevitable, but yet actually recognize that economic weakness and stock market corrections have a tendency to be short-lived. That's why he believes the Vanguard S&P 500 ETF, SPDR S&P 500 ETF trust make for surefire buys. Since the end of World War II, the U.S. economy has navigated its way through a dozen recessions. None of these 12 downturns ended in less than a year, with the remaining three found to surpass 18 months. By comparison, most periods of economic expansion have lasted multiple years, with two expansions creating crashing the decade mark since 1945. Well, it's the same story for equities on Wall Street. A data set released in June by researchers at Bespoke Investment Group showed that the average S&P 500 bear market dating back to the start of the Great Recession in September 1929 lasted just 286 calendar days, roughly 9.5 months. Hmm. Okay, anyway. So you get what he says, right? Hmm. Hmm. Okay, two growth stocks to buy before they soar in 2024. Amazon sales are tilting more toward the profitable services segment. Shopify recently returned to profitability thanks to accelerating growth and falling costs. There's no surefire way to know which stocks will generate excellent long-term returns for their shareholders. Any such forecast is even cloudier when you're looking at smaller time frames like a year or two. Yet investors can still maximize their chances of picking long-term winners. Putting several high-performing growth stocks in your portfolio would help, especially if the companies are showing impressive operating momentum in expanding markets. Two great examples today are Amazon and Shopify. Let's look at a few compelling reasons to buy these tech stocks today. Amazon has options. Amazon will issue its first official 2024 outlook as part of its fourth quarter earnings release in early February. And investors don't have to wait until then to buy the stellar growth stock. It's capitalizing on several huge growth avenues right now that all combine to add $16 billion to its quarter three sales footprint. Those gains came through a higher demand in the e-commerce business, which has now emerged from its post-pandemic growth hangover. The even better news came from the Amazon Cloud Services division. The unit anchored by the Amazon Web Services platform is growing faster than the digital storefront. It's much more profitable and delivers extra stability thanks to high proportion of software as a service sales. Amazon executives are all in that growth to flow into higher profitability too. Operating income soared to $11 billion last quarter from $2.5 billion a year earlier. Hmm. Operating income soared to $11 billion last quarter from $2.5 billion a year earlier. Cash flow is up over 80% the past year too, indicating more earnings growth ahead. Investors have to balance those gains against the stock price that's become more expensive in recent months. Still, Amazon has a good shot at extending its positive momentum as its business tilts more towards services sales in 2024 and beyond. There are a lot of things going right for Shopify's business right now, but the biggest reason for investors to, feel optimistic about your stock is its success at delivering more value to merchants. The rising value shows up most clearly in sales volumes, which were up a blazing 22% in the most recent quarter. So we're extremely pleased with our financial performance this quarter, says CFO Jeff Hoffmeister in an early November press release. The growth trends appear to have only improved since then, thanks to a successful holiday shopping season on the platform. Shopify's Black Friday sales volumes were up 24% year over year, come reported in late November. Shopify's profit margins are still looking weak, and growth investors will want to watch them actually over the next few quarters for signs that the company can generate sustainable, strong earnings. Well, the good news is all signs of are pointing in that direction. Free cash flow has been positive in each of the last 4 quarters and has climbed to 16% of total revenue. Stock rallied sharply in 2023 thanks to this good news around sales and earnings trends. Some further positive gains here could power positive returns for shareholders. Consider that eBay converts over 30% of sales into cash flow. If Shopify can keep making progress in that direction, which seems likely, then investors have every reason to expect continued good returns from how holding this growth starting 2024 and beyond. Okay, let's look at Alphabet here. Alphabet. Okay. Alphabet's latest update to its Gemini model segment is a top generative AI hierarchy. Hmm. Has been heavily investing in AI for some time. While it has multiple AI tools, none is more important than its Gemini generative AI model. Generative AI represents the next iteration of search engine technology. As instead of looking for a topic and the user doing them summarizing, the engine does it for you. Although Alphabet stumbled out of the gate as Microsoft launched Bing's version of it before Google's bot, the latest generative AI model has massive potential. Gemini recently launched a new update that solidifies itself as top platform for building generative AI programs. It's the first model to outperform human expert in the massive multi-test language understanding test, and also other competitors in more specialized areas like reasoning, math, and code. Alphabet has yet to recognize revenue from this product, but it will come throughout 2024 and beyond as various companies build a generative AI solution on the Gemini platform. So this is exciting news for Alphabet, and many investors may want to get in on the action. Fortunately, Alphabet trades at a reasonable 22 times forward earnings, much cheaper than many of its big tech peers with a strong upside and a fair stock price. Alphabet is well positioned to accelerate your path to becoming a millionaire. Okay. Oh, okay. Okay, as the home of potent brands like Google, Android, and YouTube, Alphabet is probably already on your radar as a potential investment. The company is a powerful role in tech with positions in search engines, online video sharing, cloud computing, digital advertising, more. In fact, Alphabet boosted on products with more than 1 billion users, with the top three being Google Search, Android, and Chrome. While the success of its various services has seen Alphabet's annual revenue soar 75% since 2019, and its operating income rise 108%, outperforming competitors Microsoft and Apple in both metrics. While Alphabet is probably best known for its role in search engines, its main business lies in digital advertising. The tech giant's massive user base presents almost endless advertising opportunities, with Alphabet responsible for an estimated 27% of the $740 billion market. Advertising spending dipped slightly alongside macroeconomic headwinds in 2022. However, Alphabet's third quarter of 2023 suggests the market is back on track. The company's revenue was up 11% year over year, beating Wall Street estimate by $980 million. Growth was mainly owed to an 11% increase in Google search revenue, a 12% rise in its YouTube ad segment. Alphabet is on a promising growth trajectory, dropping $77 billion in the free cash flow last year. The company has a very vast financial resources, which it is important to invest heavily in AI. The company unveiled the highly anticipated AI model called Gemini last December, has plans to venture into the chip market. Alphabet has the brand power and significant cash reserves to see big gains from AI over the long term. Okay, let's call it a day. Today this is it, and see you guys and happy Friday. Not happy Friday, not happy Monday night. Okay, see you and bye bye everybody. Bye bye.